Hello everyone and welcome to today's morning market. So today I'm going to focus in on the recent asset price movements since the election of Donald Trump. Okay, so when we look at equity markets, the real winner has been US equities. But why is that? Now, what we've seen is Trump look to cut corporation tax. He wants to cut tax for higher earners, and also he wants to reduce regulation, and all that has let investors flock towards US equities. So US equities have been the dominant asset class since Donald Trump was elected. But what else has been happening regionally within equities? Well, actually the opposite of the US would be Europe. So Europe's been the laggard. Now, what we've seen here is the threat of tariffs, so anything from 10 to 20% on products that are imported into the US from Europe, but also the fact that Trump has guided to potentially much lower or even no defense spending in respect of Ukraine, where you also have quite a divided bloc of countries within Europe. That's also been seen to be quite problematic. So you've seen actually money flow away from European equities overall. But we're multi-asset. We're not just invested in equities, we're invested in other assets as well. Probably the most interesting one for me has been currency. So if you think of what has been called the Trump trade, so what is that? Well, the Trump trade means a trade on assets that do well in a more pro-inflationary environment, an environment where maybe we don't see as many interest rate cuts as what was initially priced, say, 6 or 8 weeks ago. So within that, we've seen the dollar do very well. So the dollar up from mid-September around about 6% overall. So obviously, if you're a currency investor, you look for the currencies that have the highest rate of interest. Therefore, if you expect interest rates to come down slower in the US, then actually you start to see money flock towards the dollar overall. So seeing dollar strength come through, and also some weakness within US government bonds. So you've seen US government bond yields climb upwards. So that's actually a negative. So when yields go upwards, prices go downwards. But within that, why is that? Again, it's because of the expectation of seeing higher interest rates for longer overall. Now, what have we seen really up to date? So what did we see yesterday? Well, actually just more of the same. You saw US equities dominate returns, so they were up 0.7%, but actually you saw other regions posting negative returns overall, with Europe the laggard. Again, more of the same in respect of bonds. So you actually saw bond yields, so US 10-year treasuries yields climb around about 0.12%. And you also saw dollar strength come through as well. So you saw the dollar strengthen on a trade-weighted basis by around about 0.5% overall. Now, what have we got for you today? So today is all about the US inflation data, which is released a little bit later on. So expectations are that year-on-year headline CPI increases. So the September figure was 2.4%. The expectation is for October to be 2.6%. If this happens, this will be the first increase in inflation that has been seen for 7 months. Core CPI, so inflation but excluding the more volatile components of food and energy, is expected to stay at 3.3%. As always, we'll keep you abreast of everything that is happening within US inflation, but also everything that we think is important to your investments. Thank you very much.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.